The outlook is titled, Still Waiting for the Turn. So what do we mean by the turn? What we're talking about with the turn is two things. Number one, is the market going to change and turn up or down, or is it going to broaden, okay, which we believe it's going to broaden, okay? And what we mean by that is, if you remember correctly, when we talked the last time, we talked a lot about the Magnificent Seven and the seven stocks that really drove the market last year, and again, still the first part of this year, which has been very nice. But if you didn't own those seven stocks, okay, you didn't participate a whole lot. So therefore, it's kind of nice to see that the market may be broadening out. We're going to talk about that, as well as we're going to talk about interest rates. It's apropos to do this meeting today when the Federal Reserve is going to come out and speak somewhere between 2 and 3 o'clock today and let us know anything new that they might be thinking. We're going to talk about inflation, because nobody knows that there's any inflation right now, right? No one's paying more at the gas pump, and no one's definitely paying more at the grocery store. I think we notice it more at the grocery store than we do even at the gas pump right at the moment. The other thing we're going to talk about is the economy and whether we believe it's going to slow down. I firmly believe it is already starting to slow down. We're starting to see signs. When we get numbers from the government, those numbers are always backwards looking, right? It tells you what happened last month or last quarter. So those numbers still look pretty good, but we're starting to see some signs in there with unemployment and a few things that come out more often, that the economy is starting to slow down. We're starting to see that there are a few more job openings, and we're starting to see the layoffs as well. So what started this whole thing with inflation and all the extra spending? It had to do with COVID, right? Did we all go home and stay there? And what did we notice when we went home and stayed with COVID? We wanted to do something to our house, right? If we were going to be trapped there, we were going to do something. What else happened? Interest rates went down, right? They went down to virtually nothing. So billions were tapped into the home equity market because you could borrow at virtually nothing. So as you can see here, this goes back from 2000 all the way down here to 2021, and you can see where rates were and how much money was taken in home equity and spent. And then down on the bottom slide, this was the refinancing. The most refinancing we've seen in a long time happened back in 2020, 21, and a little bit in 2022. If you refinance today, you are not getting that 2, 3, 4% rate. You're going to get that 7%, 8%, 9% rate. But still better than what we're seeing on credit cards right now, which we'll talk a little bit about as well. So consumers are a little more rate sensitive, right? We pay more attention to it. However, we weren't for a while. We were very, very much so not worried about where interest rates were, right? Because they were virtually nothing. So we have people without mortgages, we have renters. Well, if you don't have a mortgage, or your mortgage is now much lower than it was before because of rates, what do you have? You've got cash, right? What are you doing with that money? Even if you're not putting in your home, what did we all go do? We went and had experiences, right? As soon as they said the lockdown was over, what did we all go do? We went on vacation somewhere. We wanted an experience. We wanted to do something other than stare at four walls. Anything we could do so money was spent. Another thing that led to more of the inflation. But all of these things are making it tougher for the Federal Reserve to get inflation under control. So this here is the lower payments that we were just talking about. This slide here actually shows that. The recessions are the gray lines in here, okay? The blue line, the darker blue line is the consumer debt servicing ratio, and then the light blue line is where mortgages are. And as you can see all the way at the far corner, just how low mortgage rates got. And how much different it is. We get all the way back to April, March, February 23, they're way low. There's a big dispersion there. So again, lift for homeowners, we had money that we could go spend. So the other thing that happened during this time frame was labor cost, right? What happened to labor cost? Anybody remember hearing on the television at different places that the unions were out asking for higher wages? Which rightfully so, everybody's going to go out and ask for higher wages. But also, what else were we seeing? We were seeing that the basic wage went up, right? We're seeing in some places where people are getting $20 an hour to work at the local fast food local places. So when we're seeing those kind of things happen, we know that that's going to keep inflation high as well, because those costs are going to get passed down. So easing labor costs, if we start to see the labor market ease, is going to make a big difference. As you can see here, we've got the goods and costs of labor in the dark line, and then the labor cost is starting to finally wane in the light blue line. So we're starting to see that just a little bit just recently in the report on unemployment, and that those kind of numbers are tending to come down. So sticky inflation was the kind of inflation we were just talking about, right? We have our housing cost, we have our food, we have our energy, all those are pretty sticky. When they go up, they rarely come back down. So this is what we're worried about here, is that is finally starting to show some sign of easing. We're starting to see some labor costs come down. We're starting to see some of the cost in services come down, which we'll talk about in just a minute. But either way, core services, ex-housing is the dark line, and then the core ex-housing is over here on the lighter blue line as well. So we're starting to see, as you can see, as we're getting down here, we're starting to wane down all the way at the very end down here in May of 24. That number started to really drop off. We started to see some layoffs and some other things come. So we'll start to see that some of these services costs are going to come down. So what's our forecast? All right, this here is going to give us all the different key variables, quarterly, annual, what do we believe we're going to see? So where do we think that we're actually going to see GDP? By the end of the year, we believe that we're going to see GDP, unfortunately, only about 1.8%. So that's not a very good growth rate, right? That tells me that things are slowing down. In this first quarter, the second quarter, the numbers just came out, it was a little bit higher than that. It was a little bit higher than 2.2, but not much. So pretty close to on target here. As you can see, it was much higher back in 2021, and now it's going to work its way back down. We look at the unemployment rate. The unemployment rate came in the other day about 4.1, not 4%. That was the estimate was 4%. We're starting to see that go back up again. Partially, the biggest contributor to that right at the moment is the automotive industry. Been lots of layoffs in the automotive industry. We'll talk a little bit more about EVs and part of what happened with the automotive industry going forward. CPI, Consumer Price Index, it looks like it came in about right on target at 3.1 in the second quarter. It looks like we believe that will drop some too, which means that core inflation will probably drop. This is what the Fed is trying to get down to 2% and is struggling to get it there just because, like I said, you've got a few things that are still very, very sticky, and when they go up, they're very difficult to get them to come back down in cost. So with all that said, what's happened to the stock market? Has it been a pretty good year so far, right? Stock market's done pretty well. We look at the S&P 500, it's up about 14.5% year to date. The Dow's up a little bit more than that. They trade places back and forth depending on what month it is or what year it is. One year the Dow does better than the S&P, the next year the S&P. So the Dow is only 30 stocks, the S&P's 500. Probably get a little bit better representation of what's happening with the S&P 500. But one of the things I want to talk about there is, again, we talked about the Magnificent Seven, which is still going to be at the very top. Okay, have double-digit returns, but there's still over 200 stocks in the S&P 500 that are negative for the year, and another 50 stocks that are earning maybe 1% or 1% positive for the year. So it's pretty much a mixed bag. That's part of what we're looking for the turn on. Are we going to see that broaden out and go into more stocks versus just that upper part of the stock market? So the bull market is approaching its second anniversary. So what does that mean for us? We look at history to tell us what does it mean. So we get over here, we're going back to all the way to 1949, and our chart goes all the way to 2022. These are bull markets and what happened during those bull markets. The average return for the life of that bull market is about 60%, as you're looking right here. We've had a couple of years where it's more. We're looking down here where last couple of times it was more. Right now we are right on target to be about average for the second year. We also have another thing that's happening this year, right? Anybody know of a thing called an election? Anybody ready for the commercials that are yet to come? I know that, I look forward to that. I look forward to the robocalls even more than I do all the commercials. So, because they never seem to stop. So, what happens when the Fed pauses? So we talked a little bit about the Federal Reserve a little bit earlier, right? Federal Reserve has not raised interest rates, right? They got them to a certain point, and then they do what they call as a pause. So what happens during a pause? The stock market tends to do very well, okay? Because it's coming from a bad situation. Things got better, so they started raising interest rates. When they stopped raising interest rates, the Fed tends to pause and not do anything. So our biggest concern is what happens on the other side. If the Fed starts to lower rates, why are they lowering rates? What's the reason that they're going to lower them? Are they lowering rates because the economy is slowing and they need to? 9 times out of 10, that's the reason. And that is going to be the reason this time, is that rates are going to get lower just due to what's happening in the economy. So if we look here at our chart, we've got -10 all the way up to +25, and then we go all the way across here in number of days in between pauses. As you can see, our current one, we're up about 20.5%. That's pretty average, okay, and what we're going to see as the market going up. With that said, what does that bode for the rest of the year? And that's part of what we're here to talk about. Do we believe there's more to get? Normally in an election year, the answer is yes. And normally in an election year, whatever you get in the first half of the year, you get in the second half of the year. I find that hard to believe without some great earnings. But you also have lots of other variables between now and then, and the biggest one is going to be volatility. We've seen the volatility index spike and almost get back to April highs when it was the highest so far this year. So we're looking to see what happens. So like I said, earnings are going to be key. So far, how have earnings looked? They're kind of a mixed bag, right? Like I said, what's happened to the auto industry? Did anybody see any good earnings out of the auto industry? No. They all went all in on EVs and they didn't sell them. So now they have a problem and they're looking to fix that. What about fast food places? Are we seeing, how did we see all those come out? McDonald's numbers weren't good. They just were not good, partially. In their case, it was wages. So we have another issue on things not getting much better. So if we don't see earnings, okay, then we're not going to get the continued growth. So today is one of the first days. I think NVIDIA comes out today, or is NVIDIA tomorrow? Tomorrow. So anyways, the Magnificent Seven all reports this week. Meta's today?
Yeah,
okay.
think, yeah.
So either way, that has been very volatile. Intraday, very volatile. We're seeing 3 and 4%, 5% moves intraday on those big stocks. So I think I looked this morning and NVIDIA was up 7 today, but I think it was down 5 yesterday. So, like I said, the volatility is here right at the moment. And so it is key to, now they have to prove to us they're worth the price that they're selling at. They have to have some earnings in order to make that worthwhile. So that will hold the key to us keep moving forward. But other than that, I'm not sure what the catalyst is then to get us to the next level. So the other question is bond market, okay? Now, I know our industry has not got the bond market right in a very, very long time, okay? So interest rates finally moved up this last year, not that we really wanted them to move in the fashion that they did move, but we're at rates. Rates are really about historic norms. They're really not much different. Historic norm is right around 4%. Our Fed funds rate is about 5.5% right now. So they're at historic norms. What this here is showing you is that if we don't believe the stock market is going anywhere, which we're not sure that it's going to because we've had such a good run so far, are we getting any bang for our buck to take the risk in the stock market, or are we better off to take our 5% that we're going to get in the bond market? So we have to weigh both of them out. So it is good for us no matter how we look at it. We rarely put a portfolio together that's 100% stocks, right? For the very young, you might be able to afford to do those things. But for most of us, we need to know some of that money is still going to be there if the market goes way down, and still get our paycheck, especially in retirement, right? We want to make sure we're still going to have some. So we rarely develop portfolios that are 100% stock market. They're normally, 60-40, 70-30, something where there's some kind of bond portfolio. For many years, on that portion of your money, you got nothing because interest rates were virtually zero. Now we're finally starting to see that part of the portfolio do well, or do at least what is expected and give you some kind of return. So that's basically all that's talking about in this slide, is that are you getting paid to just be in stocks at this point, or are you just as well off if you were in the bond market? So, election, my favorite topic. because I just love the commercials and all the chaos that goes along with it. So in this particular area, we're going to talk about fiction versus fact, because there is a lot of fiction out there on what's going on when it comes to the election and it comes to the stock market returns. Just lots and lots of fiction. First one is going to be it doesn't matter who wins. It may matter to you personally, it may matter to you in your belief system, but as far as the stock market goes, it does not matter, okay? So we have Democrat blue and we have Republican red. The top here is who's the president. So if you look here, okay, if we have a Democratic president, if he has a Democratic Congress, average return is about 8.6. If he has a Republican Congress, it's 16.3. And if we have a split Congress, it's 15.7. If we get over here to the Republican side, we have, with a Democratic Congress, we're going to have 6.7. Okay, if we have a Republican, they don't do as well. They obviously don't agree as often, I don't know, 4.9%. And then if you have a split Congress, you have a 13.7 return. So as you can see, it really has more to do with Congress and about them either doing nothing, which sometimes is better, right? No new regulation we all have to deal with, okay? Because all of us like to deal with additional regulation. Or is it they have to actually talk to one another and make something work? When was the last time they passed a bipartisan bill? I'm not real sure when that was. Not very often in the last few years, that's for sure. So that's the one here. This slide is even more interesting to me. This slide goes all the way back to 1950 and goes all the way to present day. And what this here is all years invested, Democratic only in blue, Republican in red. As you can see, all the way up until about 1982 to 86, okay, they were all fairly the same. Didn't really matter if it was a Republican president, a Democratic president, or you just kept your money invested and you didn't care, all right? So this is $100,000 invested in the market. What does it turn out to be? Okay, so if you follow the red line and you're Republican and you only invested when there were Republican presidents, you have $1 million on your $100,000. If you were a Democrat and you decided to only invest when the Democrats were in power, okay, you have about $3 million. If you just left it alone and forgot about who was president and just thought, I want to invest in the market, you'd have $32 million. So again, it's really not about who's in charge. It's really about putting your money in the market. Now, with that said, are there different things that are going to go up and down depending on who's president? Absolutely, okay? Is oil going to do better under one president than the other president? Yes. There's lots of things that you can go back and forth on. You know, one side likes the environment more than the other side says they like the environment. We have lots of different things that can change that's going to tell us which way we want to, or maybe what sector of the market we're going to invest in. So that may change, but as far as getting out of the market or not investing, that is just simply not how we're going to do this. It doesn't matter as far as the actual stock market is concerned. So bonds, we talked a little bit about this a minute ago, right? And bonds are providing income again, right? Do you make some money on your money market fund today? Maybe not a lot, but you make some, right? Where once upon a time you made 0.01. So at least now maybe you're making 1%, 2%, it just depends on what you have, but you are making a little bit of money in the bond market again. One of the things that we want to talk about though is how does that work, okay? So higher neutral rate. So we firmly believe that rates, even if they start to come down, Federal Reserve comes out today. It will be a very big surprise if they come out today and say they're lowering rate. There's only about a 3 or 4% chance that's going to happen. So that would definitely be a surprise to the market if it came out. But the rates are going to stay higher for longer. So what they're telling us is that yes, they're going to start to come down, but they are not coming down to the historic lows we saw before. Basically, we're going to get back to that normal rate is basically what we're saying. And that's really what this slide and what the market itself is telling us. When we look at the bond market, it is still inverted. The 2-year and the short end is still a much higher rate than you're going to get on the longer end. I'm not sure where the 2-year was this morning, but the 10-year was only about 410. I think that the 2-year is still around 4.2, 4.3, somewhere in that neighborhood. It's not inverted anywhere near what it was, but it is still higher than where it has been historically. So we talk about the bond market, and we like to look at our bond funds, and we like to look at the individual bond. If I own a bond today, and I own it, and it has a 5% coupon on it, and interest rates go to 4% next week, is my 5% bond worth more than that 4% bond? And the answer is absolutely yes, because who wouldn't want my 5% bond? You're going to pay more for it if you can get 5%. That is not typically where we see returns come from in the bond market. You may make some, okay, money on your bonds, but typically they really come, the largest contributor is just the income. It's just the coupon. So if your coupon's 4%, more than likely that's what you're going to make. If you already own a 5% and rates go down to 4%, you're going to make a little extra on the growth of that. But for the most part, 90% of your return is going to actually come from the coupon itself and not from the price appreciation. So I think a lot of people have that fear of missing out, just like we do in the stock market. They have that fear of missing out on the bond market. It's not going to get you enough extra, 9 times out of 10, to rush in and go buy those bonds at this point. So, but one of the things that's happened just recently, if you look over here at the far end of this, is cash has done better, right? Cash has done better in the last year than the actual bond market has. That is not normal. That is not normally what we see. We normally see that if we look at 5-year trailing returns, that the bond market normally always does better than actual cash. Right now, because of the inverted yield curve, it is not. You are still better off in short-term money. When that changes or when it flips is anybody's guess. The betting people will tell you that it's getting ready to happen here in September, right? We're going to get our first rate cut. At that point, we believe that the yield curve will probably no longer be inverted and that you will be better off being on the longer end of the market than you are on the shorter end. So right now I can get as much on a three-month treasury bill as I can on a, probably about a 3 or 4 year CD. I'm not going to get any more money. So I might as well keep it short at this point. My money's more liquid. So money market funds are still paying 5% in some places, or over 5%. You're not getting that much on some of your bond funds. So something we don't talk about very often is alternative investments. And so we're going to talk a little bit about other bonds in other countries. So there's been a dispersion as to what happened after COVID, right? After COVID, everybody had locked down. All the economies did a little bit different things, and they all reopened at different times. It also has the same thing that happened with those economies. What the Federal Reserve was doing here versus what England was doing versus the Bank of Japan, all of them did a few different things, and these are all just central banks and the different dispersions between all those banks. So not very often is it a positive, but it is right now to think about whether or not we want to put more money or put some money into globalized bonds and to something other than just the U.S. and the bond market there. The other one would be is, do we want to start to invest some money internationally, which we have just started to do. We don't have much there, but it would be something else that we would be looking at as well. The other thing we're looking at here, though, when we're looking at things that we have to worry about is in the bond market, where do we put our money? Historically, the rates for credit defaults are very low. This particular slide shows you that they're starting to pick up just a little bit, but still below historic norms. So if you're looking at something that's got a higher coupon on it, you need to know what the credit quality is underneath it. So are you buying a AAA bond or are you buying a BBB bond? It's going to make a difference here, which is something we look at on a regular basis. We're not much into buying private credit bonds. That's something we've looked at too often. Every now and then we will. Floating rates tend to get into some of these floating rate bonds. We'll buy some of those kind of money market funds, and they tend to buy some of these things as well. Commodities. Anybody hear the commercials for gold these days? Does everybody tell you need to go buy some gold? They come and go in spells, and that's definitely one of the ones that's talking about things right at the moment. Gold is in an uptrend. I'm not sure about how much higher it's going to go, but gold is definitely in an uptrend. In this particular one, we're really talking about copper, and we're talking about the upswing. It has slowed down a little bit in the last few weeks, but copper is doing extremely well. Why is copper doing well? Anybody know? Anybody want to make a wild guess? EVs, electrical vehicles. They need copper in the vehicle. They need copper in the batteries. They need copper to make charging stations. And they need copper to fix the electrical grid. Maybe they ought to fix the electrical grid first, and then we'll go worry about all the rest of it. But we don't always. Sometimes we get that horse, that cart right in front of it before we keep moving it up. But all those things are going to come to play. China's a one we used to always watch because they were big consumers of copper, so we watched to see if China was buying copper because that meant they were getting ready to do something. Not quite as much anymore as a telltale sign, but it is still something that we pay attention to. And they have their own set of problems in their economy right at the moment. But copper is really, for us, it's more about this whole EV cycle and the change there, which is kind of scary right at the moment. So currencies, strong dollar, okay? We don't play currencies too much, it's not something we do, but it is something that you have to pay attention to. And the dollar is stronger right now, and the dollar will stay stronger. As long as interest rates stay higher, we're going to see the dollar stay stronger. So unfortunately for that, it means that a strong dollar for emerging companies, smaller companies, sometimes that's harder for them to pay back when the dollar is stronger. The emerging markets, most of those have to pay back their loans in US dollars. So if the dollar is higher, it makes it a little more difficult for that to happen. But we do believe that when rates start to come down, we'll see the dollar come down some. I'm not a proponent of a soft dollar, but at the same point, if it gets overdone, then it makes it very difficult for parts of the rest of the world to operate. So now we get our general disclosures. We wouldn't want to miss all those extra things. So I know I've talked a lot about a lot of different things. Bottom line is, we are still positive on the market. We do believe that we are going to get a positive return before year end. Rarely have we ever seen, I think it's about 80% of the time that you see just a flat market. 90% of the time the stock market is good in a presidential election year. But we don't just have a presidential election year, right? Congress is going to get, how many seats? 235 are up in Congress and another 35 are up in the Senate. So there's a lot going on. It's not just the presidential election as well. So we tend to see positive returns in the year of an election. We tend to see if the first half of the year was positive, unless there's some major crisis, we see the second half of the year as positive as well. Do I think we're getting another 14%? No. Okay, I just don't. I do believe that we will get one rate cut. I don't believe we're going to get another one this year. I'm not even of the camp, even though I'm probably in the minority, 97% chance we're going to get a rate cut in September. I'm not so certain it won't be later than that. It's really going to matter with how the earnings come in the next few weeks to see. And again, what he says this afternoon, what they're seeing right at the moment. They have better things to look at than I can look at, that's for sure. So we'll see what they have to say. So currently our portfolio is about a 50-50 mix. Normally we'd be about a 60-40 mix on our average client. Trust me, I have some that are 100%, some that are more, but for the average client, you're normally gonna see about a 60-40 mix. We're 50-50 right now, just because I believe you're going to get as much money in the bond market. We did start to add small caps, which are the smaller companies, to our portfolios here about 2-3 weeks ago. That is a component of lowering interest rates. As interest rates come down, those smaller companies don't have the big balance sheets the other companies do. So they have to borrow money at higher rates. When rates come down, those companies tend to do very well. We still have mid caps. We have kept that right at historical rates. So we have the middle of the market. And the large companies are just going to get larger. What is the biggest topic of conversation these days? AI, right? I don't know how AI works. Probably never going to understand how it works. I know my phone talks to me even when I don't want her to. She doesn't answer me when I want her to. But there's AI in everything we do. We use meetings online, and we now have AI on all of our meetings. If you go to Zoom, you can click a button, it'll record everything, and then it'll send you a transcript afterwards. So AI is here to stay. It's not going anywhere. It's in everything. I'm redoing a kitchen. I think all of my new appliances have chips in them, okay? So that it can decide it's time to start the washing machine, it's time to turn your oven on. Okay, maybe dinner will be ready for me when I get home. I don't know, but it's kind of where it's going at the moment. So, like I said, we are We are still very positive on the market. I don't want you to think we're negative. We just believe we're probably going to get as much bang for our buck out of the bond market as we are the stock market the second half of the year. So that's why we're kind of in the middle there and doing the 50-50. Something could lean one way or another because we're no shortage for news cycles, right? When this was written in mid-June. What's happened since mid-June, right? We've had an attempted assassination on a former president, okay? We've had a president drop out of a race. When was the last time that happened? In the 60s? And we've got a female running for president. Okay, so that's historical. So there's lots of things happening, and that's what's going to keep the volatility up.